Good afternoon. Oh, wow, that was actually kind of impressive. Thank you, sir. My name's Matthew Van Dyke. I'm going to be your MC again this afternoon. This is my 4th year presenting the Ethica Private Wealth Specialists Christmas function, and my first thank you needs to go to all of you for taking the time to come and spend your afternoon with us here today. You won't see a lot of me in the business. I tend to come and spend time at Ethica when you're not there. My role is as a bit of an interesting title, but I tend to work with great businesses like Michael's on their asset and investment management. Our speaker today I've known for a number of years and worked alongside him, and what I'm expecting you'll be able to do from Brent's presentation today is learn a bit about, or learn some more about, some of the investment principles which are applied daily to your portfolios and investments through Michael that you won't see happening. It's a bit like a duck swimming on a pond. Duck looks nice and serene on the top, but madly those legs are spinning again and again and again to try and keep that duck paddling through. So a little bit of housekeeping, get out of the way early, which is apparently an important duty as an MC. For those of you located on the exit rows, please make sure you keep the exits clear. The doors are at the back of the room. If you're looking for a bathroom, it is through the second set of glass doors. It's moved from last year, for those of you who are here, but through that second set of glass doors down the corridor on your left, you can find bathrooms. Now, in the event of emergency, please make sure you pick up your drink and make sure your partner has their drink firmly in hand before making your way out of the room. And make sure it's full. Make sure it's full. Whenever I am asked to present, I have a little bit of a think before I look at introducing the main speaker, and without wanting to steal any of Brent's thunder today, I like to take a bit of a moment to perhaps reflect on what's happened in the year and what's gone on. And while there are no prizes for this next question, so it's a question, so this is the participatory part of the speech at the moment. Can anyone tell me what major financial event happened 10 years ago this year? GFC? I'll take GFC. I was probably looking for something more specific. It was what maybe started the GFC to kick off. Did I hear Lehman Brothers? Yeah, bang on. Thank you very much. Well played. I really should have a prize, shouldn't I? I'll sort something out later. So Lehman Brothers, the 4th largest investment bank in the US, filed for bankruptcy. It was a monumental change. They kicked off a raft of differences around the world in terms of how we look at investment, how people view various parts of investment, and really what I like about businesses like Morningstar is they're not ones to get suckered into the story. One of the great things about considering value investment. So you hear the term value investment, a lot of you don't scratch your head too much over it, you'll have a haircut like mine. What value investment is, what I'd like you to take away from today and think about it, it's about making sure that you buy good quality assets at the right price, ideally a cheap price. If you've got an expensive asset, you sell it. Because what you don't want to do is buy high and sell low. Behaviourally, what a lot of people will do is say, hey, everyone else has got it on this. It's gone up in price. I'll get into it now. That sounds great. Hang on. It's fallen in price. Still a good asset. What am I going to do? Well, I'm not worried about that. Sell it. What's also happened after the GFC kicked off over the last 10 years, and I consult the firms from as far south as Yamba up to Cairns. That's my particular patch that I look after for my company. Over the last 10 years, we've had very benign winds, to go with a little bit of nautical theme today, in investment markets. What I mean by that is it's been a fairly nice and pleasant run. There have been nice returns that we had year in and year out. Where the actual return comes from changes, and that's why we need good managers like Morningstar to help them navigate those particular waters. But if we look at what happens, markets, unless everything that I've learned over my postgraduate studies, I finished my Masters this year. I was talking about it last year. Someone in the room was going to help me pay for it. John, are you here today? John, you going to put your hand up? No, okay. I'll send you the invoice later. So having finished postgraduate, markets tend to run in cycles. We had the GFC 10 years ago. Does anyone want to tell me what happened 10 years prior to that? About 20 years ago, I'll take that as an answer. That was Wall Street. That was a very short, sharp sudden event that took place. 10 years before that, does anyone want to tell me what happened 10 years before that? Sorry, late 90s, by the way, we had the first tech wreck I've done along. And put that in. Someone was only 15, 30 years ago. You're holding up well. Yeah, we have credit crunches and oil prices. So I'm not going to tell you that something's going to happen tomorrow. I'm not going to tell you something's going to happen next week, next month, or even next year. But if markets continue to run in cycles, what we want to do is make sure we've got our investments set up to not only protect ourselves from those downsides, but we've also got the ability to take advantage of them when we have good assets that come along at a good price. So I'm half Dutch and about a quarter Scottish, to let you know, so that not only makes me really tight with money, but a little bit arrogant enough to think that I know what to do with it. But that's the sort of approach I really value as well. So today's not about me rambling on in front of you. I'll give a few quick thank yous before we introduce our main speaker again. First and foremost, can I ask everyone just to put their hands together to Michael again for hosting. Some quick introductions. David is here somewhere, my result manager, who I know Michael simply could not do without. We've got Di Bland, Michael's office manager. Jen Burrows. Jen, where are you? There we go. Excellent. Does everyone know that Ms. Burrows drives the correct car, by the way? I actually have a deep and abiding affection for Jen because she has the simply best car on the planet, which, what's that, you're asking? It's a Mazda MX-5. If you've never owned one, buy one. It is the cure for what ails you. And make it your passion. This time last year I was in Japan visiting the Mazda factory in Hiroshima, actually having a look at these things being put together on the production line. I drive one as well, they are good. You should all own one once in your life. I own no shares in Mazda, just saying that. At least I don't think I do, but they are brilliant. So live your dreams, live your passion. That's a lot of what Michael and his business is about doing, is helping you plan toward what's important in your life. Chef Antonio, are you here still on the premises? Yes. Antonio, thank you again for hosting us this year. So without much further ado, Brent Finneran, who I'm going to introduce. I've known Brent for quite a few years now. He's worked for Morningstar Investment Management over the last 5.5 years. He's the State Manager for Queensland for their investment management business. Brent today is going to be delivering his presentation to you in two parts. The first is going to be focusing on what a value-driven approach really means, so you can think about this and what it means to give you some safety and comfort around Michael's ability to help you grow, manage and protect your wealth. Please welcome Brent.
A little bit luminescent. So I've actually been running Queensland for our business for the past 11 months. I moved up from Sydney 11 months ago, where I used to look after all the southern states for the business. I did move up in part for the weather, and it's a funny thing. Most times that I come up to Maroochydore, it's like this. You know, it's supposed to be beautiful one day and perfect the next, but I don't believe it. Not one little bit. So it's an absolute pleasure to be here today, and it's great to see.
Brent, you've got to stop bringing the weather from the Gold Coast up here.
Yeah. Yes. It was blue skies this morning. I'll have you know that. Okay, so look, it's an absolute pleasure to be here. It's an absolute pleasure to work with Michael and the team. And it's great to actually see the end clients. You know, the people that actually invest the money in our portfolios. I know that you've spent some time with some of my colleagues in the past. Last year it was with Clint Abraham, who's an investment specialist. And perhaps the year before that, again, was Clint. And the year before that was Regan Van Berlo, who was our head of distribution at the time. But what I'm going to do for the first part of our talk today is to talk a little bit about our principles and why we do what we do. I think that's most important. And it's just not always about the markets and what is happening in the markets. It's about how you think about placing your money in the market that counts. Because if you do the wrong thing, you can lose money. You know, and our strategy is all about value investing. And it's not new, it's been around for a very long time. So I'll take you through a couple of things in this presentation. Now, I haven't worked out how to move to the next slide. There we go. Magic, like magic. There we go. I should have picked that up in the first part. There it is. Okay. So our approach to investing will be the first part of this presentation. So it's a tale of two halves. The second part will be all about the market opportunities and where we see risks. But more importantly, why we're invested there in the first place, or not invested there. Okay. Hang on a second.
Towards the left of wherever it is.
Which button must I?
Probably the right one.
There we. Oh, okay. I'm pointing it the wrong way. I think that was a problem. Yeah, there we go.
When you push the button, there's a little bit of a delay.
Oh, okay. Thank you. Okay. So I know that you've already heard from Morningstar in the past, over the past couple of years, but I thought I'd just take you through a quick overview of our business. Morningstar was founded back in 1984, so quite some time ago. It was a research house originally that's morphed into an investment management or fund management company. So back then it was Joe Mansueto who founded the business. It was in his 2-bedroom apartment in Chicago. And he started with $80,000 in capital. But his mission from the very beginning was to help the end investor make more sensible or prudent decisions when it came to their 401k plans. Now, since then, we've expanded. Over the past 30 plus years, we have 27 offices around the world. We've got 3 investment hubs, one in Sydney, one in London, and our hub or mothership is in Chicago. If you count my office in Benoa on the Gold Coast, well, then that makes it 4. But we've got 101 investment team professionals, so these are people that have MBAs, PhDs or CFAs. I liken them to propeller heads. The people that actually do the analysis and manage the money. So they're very important people in our business. We've also got analysts. So these analysts cover equities, bonds, and a number of different asset classes. There we go, sound. And we manage more than 280 billion in capital. Okay. I don't know where to point this thing. Oh, there we are. Okay. There we go.
Where to, that's all.
Okay, look, I'm still learning. I still love my toys, and there's one over there that I need to become more accustomed with. Okay, so when thinking about the markets, one of the things that who's heard of Warren Buffett? He's a value investor. Okay, he tends to buy whole companies or big fractions of companies, but he's a value investor at heart. And one of the things he said to another famous investor, Howard Marks, who runs Oak Tree Capital, that's a hedge fund. They manage about $130 billion in capital. But one of the things he said was that what you really want to do with investments is figure out what's important and what's knowable. And all too frequent in this world, we tend to focus on things that are unimportant and things that are not knowable. And it's the things that are not knowable that cause the most noise or frustration with the way that we think about investing. And what he also said to Howard was that if it's unimportant or unknowable, then you need to forget about it. Now, with Morningstar, we tend to focus on value in asset classes. We look after more than 350 asset classes worldwide. And we also focus on the underlying securities that make up an asset class. And to value any asset, you need to understand the cash flows. Okay, and then you need to discount those future cash flows to understand what its value is. So if you can do that for a particular asset, then you can do that for an asset class, like the ASX 200, for example. Now, when thinking about the markets, it's very hard to forecast what is going to happen. And what I mean by that, it's very hard to predict what is going to happen in the markets. It's not an easy thing to do. Even macro fund managers do this for a living and cannot get sustainable good returns over the very long run. Part of the reason for that is that the markets move in cycles, which I'll touch on in just a moment. Okay. There we are. Okay, a bit of a delayed reaction there. So thinking about the things that matter. There are a number of things that are taking place in the markets as we speak, and no doubt Trump has to be the first factor, right? Right. If he's not tweeting, he's somewhere. He's in my presentation. Look, it's certainly an important factor, the fact that that he's president, and he's leading the US. He's done a lot of great things for the economy, in that he's lowering taxes and he has a lot of influence. That's for sure. But my goodness, there's a lot of noise in the marketplace, and since him becoming president, the Dow has moved from around 18,000 to where it sits today at close to 26,000. So it's had quite the run. And one of the things I like to talk about, especially with the US, when you think about the value of the market, there's only 2 times in history where it's been more expensive. And that's the dot-com crash that Matt Van Dyke talked about, and the 1929 Great Depression. So just think about that for a moment. So at current valuations, it's more expensive than the GFC, which was 10 years ago. It's more expensive than the 1991 depression, the 1987 crash. I mean, these are all big, monumental events in investing. And the market in the US is more expensive now than all of those times. So it warrants caution. Brexit, nobody really knows what is going to happen with Brexit. It was supposed to take place a while ago, but it's still ongoing. It's taken about 2 years now. It's unbelievable. But I think the D-Day is the 29th of March. So we're all very excited to find out what is going to happen. But I will talk to you a little bit about how we're invested and how we're getting exposure to Britain in our portfolios. US interest rates, look, they've been at historical lows for quite some time, since the GFC, and they are slowly moving up. So that's important to note, because if you think about how important interest rates are to the way that you value any asset, it's based on the cash flows and the time value of money. So as interest rates rise, slowly but surely, the value of any asset will depreciate. Okay, so interest rates have been low for quite some time and they are moving up. The Fed have gradually been moving rates up. Rising debt levels, there's no surprise there. All over the world you've had not only fiscal policies but monetary policies whereby governments have invested a lot of money into the market, which has buffeted asset prices globally. The concern is that when interest rates are so low, people tend to borrow more money and they somewhat become overexposed to debt and the market. The problem is when interest rates move up too high and they can't service the debt. It happens in every asset class, particularly property. Emerging markets uncertainty. So you would have seen emerging markets come under a bit of pressure lately, and I think largely that's due to what was happening with Trump and tariffs. He has put quite a lot of pressure on lots of countries, including China, but the likes of Turkey and Argentina, and those equity markets have suffered as a result. But that's also placed a bit of pressure on emerging markets and their currencies. But from our point of view, emerging markets are a great opportunity. In terms of the current value relative to historical measures, it's one of the best investments that you can be in at the moment. And North Korea, Iran, I think that look, the world's a dangerous place, especially when you've got people looking to build nuclear missiles and things like that. But if there's one thing that Trump can do right, it's if he can put a stop to all of those nuclear missiles and things. I think that'll make the world a safer place. But if there's one thing that you can count on in investing, outside of the unimportant things and the unknowable things, the one thing that we do know is valuations. That's the one thing that we can count on in getting results for you as clients, and also making sure that you meet your objectives over the very long term. So valuations is what we do best. I can't believe it worked. That's my fault. A good workman should never blame his tools. So, okay, so looking at the 4 pillars of valuation-driven investing, we tend to break it up into 4 parts. Okay, so we've got absolute valuation. So we look at what an asset is worth, what the intrinsic value is. You know, you need to know what something is worth before you buy it. Otherwise, you don't know if you're buying it cheap or expensive. It's much like buying a house. You know, if you're buying an investment property, you want to have a good idea as to what it's actually worth before you place some money on it. The unfortunate thing is when debt is cheap and you can borrow lots of money, people tend to pay premiums for properties. And as the market continues to move up, you feel as though you're missing out on an opportunity, or that the current prices are just what you're expected to pay. And so you keep bidding up and up and up. And if you think about the Sydney property market at the moment, you know, it's down on average around 7 or 8% in just 12 months. It's actually the worst annual decline since 1991. So these things do happen, property prices do fall. But just remember, if there's one thing that you can control, it's the price that you pay. Now, relative valuation fits in with our investment belief system in that, you know, we cover 350 asset classes. So not only do we work out what an asset class is worth on an individual basis, but we think about how it ranks relative to all the other opportunities in the marketplace. We also look at at contrarian indicators. Now, I'll give you one example of this. But you know, we have a team of behavioural scientists in the US. They work in our Chicago office, and they actually, you know, their job is really just about gauging the market, understanding how people think about investments. You know, contrarianism is really at the core of what we do. Okay, we refuse to buy overcrowded investments. You know, we look for the good opportunities, and in doing so, it takes a lot of discipline and a lot of patience to make sure that we deliver on those results.
Brett, can I ask you a question?
Sure.
What do you mean by overcrowded investments?
Has anyone heard of Bitcoin? Okay, so Bitcoin, you know, it's known to be an asset class, although, you know, there's no cash flows that are derived from Bitcoin. There are some certain advantages to that particular asset that we'll see, you know, as it's adopted into the ASX and things like that. But going back to overcrowded and paying more than what it's worth, you know, Bitcoin was a bubble. You know, if I had have invested in Bitcoin 12 months ago, how much money do you think I'd have left? If I invested 100 grand, have a guess on what I'd have left of my capital. Not as bad, 50%. I'd have $50,000. But my goodness, can you imagine buying something a year ago, only to find out that it's worth half as much now? Now, if you go back 2 years ago, okay, not 1 year ago, but 2 years ago, if I invested that $100,000, guess how much Bitcoin would have been worth today? $400,000. Right? So, you know, it's over a very short period of time. But this is going to link to what Michael just mentioned. 2 years ago, Bitcoin wasn't an overcrowded investment, okay? It was just gaining momentum. And, I mean, I had a friend that worked with me. He's since left, and he's now discovering the world. He bought into Bitcoin, and he kept on telling me, buy Bitcoin, buy Bitcoin. And I wouldn't have a word of it. Okay, I wouldn't buy it. It's not an asset class. There's no cash flow linked to it. It can be a very dangerous thing. If you've got some gambling money, perhaps, but you know, with gambling, you know, it's a bit of fun, but that's about it. So with Bitcoin, you know, it really started gaining traction about just over a year ago. It just seemed as though if you're not in Bitcoin, you're missing out. And I reckon everybody in this room knows somebody that had some exposure to Bitcoin. And it doesn't make you feel good when you hear that it's going so well and you're not in it. You think, what am I missing out on? You know, I look at my portfolio, it's a balanced portfolio, I'm in lots of different assets, but my return is nothing near what Bitcoin has done. Well, the overcrowded part is when it moves into bubble territory. And that's when, you know, you jump in a cab and your cab driver tells you that Bitcoin is a great investment. Okay? That's when you shouldn't buy. Okay? Everybody knows about it by that stage. And look, you look at the results over the past year, it's down 50%. And it could fall even further. I think it's down another 7 or 8% today. Okay? That is hugely volatile, not something that you really want to be invested in long term. If money matters to you. Okay, and fundamental risk is really the fourth pillar, and that's understanding, okay, so you've got an asset, you understand what the cash flows are, you've valued what those cash flows are over the very long term, and now you need to understand what the fundamental risk is. So are there any risks to those underlying cash flows? Okay, so I'll give you some insight with Morningstar. We have something called a moat rating. Okay, there's a narrow moat rating and there's a wide moat rating. And all that means, it links back to castles in the medieval times and the moats that are surrounding the castle. It's a protection, okay, and we link that to cash flows. How much protection is in the cash flows, and how long will these cash flows last? How sustainable are they over the next 10, 20 years? So we think a lot about fundamental risk. So these are the four pillars that we look at when building your portfolio. So there's a lot of work that goes into this, and there are so many people involved as well to make sure the portfolio is right for investment. Okay, so it was back in 2009 when Daniel Needham, he was the Australian CIO, put in place valuation-driven asset allocation. Can somebody say that 3 times really fast? I can't. I've been with them for 5 years and I still struggle. It used to be known as dynamic asset allocation. And the reason why we changed the name is because dynamic asset allocation became quite a buzzword in the industry. Everybody started to do it. And the way that they started to do it, they started to widen their asset class ranges. So it meant that instead of having a specific weight in Australian shares, for example, you'd have very wide ranges. So you could move anywhere from 35% to 70% or down to 0 if need be. The problem is that not many fund managers actually have the conviction to do that. Okay, Morningstar, we've been doing it for a long time, and it's worked out really well for us. We link everything that we do to valuations across asset classes. And so if you think about this chart here, the straight line just represents the fair value of an asset, okay, or what it's really worth. Now, just think about it for a second. If you don't know what an asset is worth, then you could potentially buy here and sell here, because you have no idea what the fair value is and what that value is. So it's extremely important to understand what an asset is worth, and you can use those four pillars that I outlined earlier to identify what that number is. Now, you may have also heard that markets move in cycles. Okay, they fluctuate over time. A typical investment cycle or business cycle lasts for about 7 to 10 years in total. And just by looking in this room, I know that you would have witnessed quite a few cycles in your lifetime. Okay? And going back to what Matt talked about, the .com crash, okay? That would have been about here. The bottom of the GFC would have been about here. The problem with those inflection points, those extreme points on or during the market cycle, is that we are all human. Okay, we have these behavioural biases that we can't escape. And when the markets are good and everybody's buying and everybody has confidence and conviction in the market, everybody wants to load up and get into the market. The problem is that people become somewhat complacent and you forget about what an asset is actually worth. And in doing so, you have much lower potential for losses. Sorry, much greater potential for losses. But when you get down to the bottom, nobody really has the gusto, right, I'll use gusto, the gusto to actually buy those assets when they're cheap. Because fear takes over. It's one of the hardest things to do. And this is why you have a relationship with Michael. This is why Michael has a good relationship with Morningstar. We know what we're doing when it comes to valuations. And, you may have been invested for quite a number of years. But if you think about the portfolios, we've been running the SMAs for quite some time. But in the scheme of things, it's such a short period of time when you think about the number of different investment cycles.
Brendan, I can't help myself. Could you give a couple of examples of maybe a couple of shares that you bought in the last 3 to 6 months that are probably not loved by the market, like people out there?
Yeah, absolutely. So pick a stock that you don't like. Any stock. Just give me one of the top stocks. Telstra, thank you. Okay. I knew it was coming.
Pick a company you hate.
Right, there it is. We often, CBA, right. We tend to own all the, if there's been a bit of negativity in the media, or, the price has fallen quite considerably, I can almost guarantee you that if it's a good company with high quality or a healthy balance sheet and high quality earnings, we'll be there. We'll be the people buying it right down the bottom. And unfortunately, we won't, in some cases it looks like it's a falling knife. It's going to keep on falling. But I'll tell you what, it makes it a lot easier if you know what it's worth. Because Telstra was up over $6, I think, not too long ago. And it fell, and it kept falling, and it kept falling. And people got out of the asset class. I know Fidelity sold their holdings. I know that there were some brokers at Bell Potter that were despondently selling Telstra. And do you know what price they sold? Have a guess. It was roughly around $2.70. Very close to the lowest. Okay? Why on earth would you sell a good quality asset? Maybe it was just before the end of the financial year, and it worked out well for them. But I think Telstra's up at about $2.95, $3 or thereabouts right now. Now the key is that it's a good quality asset. It's backed by strong cash flows. It's not going anywhere. Now, why is it in your portfolio? Well, you're invested for the long term. Okay, you're not invested for the next year. You're not invested for the next 2.5 years. That's short-termism. So you need to look deeper than that. You need to think about, making your money last. And Telstra's going to be a business that's going to be around for quite some time. So hopefully, we've bought down here. Who knows? It could fall further, but we know what it's worth, and that's the most important thing. So hopefully we get to sell when it gets to about here at some point in the future. Look, the same applies to a number of other assets that we've bought. CBA, that hasn't been favoured by the markets, it's been through the Royal Commission. I think it's priced at about $70 at the moment. But it is by far the strongest bank of the four. If you think about your portfolio relative to all of our peers, okay, most of our peers tend to own all four banks. Okay, why? It dominates the index, the ASX 200. When you look at our portfolio or your portfolio, it's not tracking the ASX 200. It looks so different. If you think about the ASX 200, it's mostly made up of resources and financials. The financials that we do own, QBE, CBA, Medibank. Okay, these are some of the businesses, but you'll find that they're all in a very similar vein. Okay, they all look good value and have high quality earnings. That's why we own them. Now the other important thing is we're not just invested in Australia. We look beyond Australia. And that's the beauty of being invested with Morningstar. We're a global business. There's a lot of people working on this. So, opportunities for us, we've got Europe, emerging markets, Japan. That's another great investment for us. Now, I'm not going to go too deep into global markets right now. I will do in the second half of the presentation. Which will begin at some point during this session. But if there's one of the best quotes from Keynes that you can take away from this is the central principle of investment is to go contrary to the general opinion. And I've highlighted that there. Because with investing, if you can just take away one key learning, you don't follow the crowd. You don't invest where everybody else is investing because it's popular. It's the wrong thing to do. Think Bitcoin, okay? And it makes complete sense, right? Okay, because if everybody believes that it's a great investment and everybody's buying the investment, then they're continuously bidding higher prices. And so the expected return or future return is becoming lower and lower and lower. So with that, I'll let you enjoy one of your first meals. I think there's 5 coming, so my goodness, we'll be here for quite some time. But I'm going to break this presentation up into 2 parts. It's a tale of 2 stories. The first one's all about the principles and why we invest. The second half is more about the markets and how we think about investments. Thank you.
Thanks, Brent. As Brent said, we're going to have a quick break now.
You're going to be fined. And it's your job to yell out and say that's jargon, and then he'll explain what that word means. So each time he actually uses that, there'll be a fine of $5. And that fine will be going to a local charity on the Sunshine Coast called Sunny Kids, which is our main charity in our business, which helps a lot of children on the coast. So feel free to have fun. Sorry, Brent.
Hang on. What's the rule on TLAs, 3-letter acronyms?
Well, what I want to do is make sure the presentation is understood by most people in the room.
Okay.
So if he's using things like value stocks, value stocks, we understand what it is, but some people in the room may not. So can you please explain that? Or if you use the jargon, like the example I use, everyone knows what shares is. But in our industry, we call them equities. Where a lot of people, we use the word equity, we think of what we own at our home. Or we could use the word stock, which is also another word for shares. When you say stock, if you're a shopkeeper, you think that's what's on the shelf. So I'm making Brent a little bit nervous now. I'm not meaning to. So I'll pass it back to Matt to welcome back Brent.
So to sum up Brent's next presentation, it's me, makey, money good. I got picked early. To try and tie a few of these together, a bit of a comment on risk. Risk is a really interesting word. Now, as I mentioned earlier, I spent the last few years doing some postgraduate study, which means I don't get out much anymore. And I find things like this really interesting. Risk can mean different things to different people, but one of the real truisms is that risk is often higher when you don't understand or have a lot of knowledge about the subject that's in hand. When we talk about risk with investment markets, as I was saying earlier in my introduction, it's been 10 years where we've had a really nice run, and what that can mean is that investors have a behavioural quirk, which means you start to focus on the return and not the risk. And people can sometimes feel that they're owed a return. There's a couple of really nice sayings I'll interject at this point, which is markets will often remain more volatile, will remain volatile longer than you can remain solvent, which is a good one to bear in mind, meaning that markets will do whatever they want, which is exactly what you don't want them to do, longer than you're comfortable with them doing it for. That brings me to my second point. One of the biggest factors in anyone destroying, eroding, or reducing their wealth is often their own behaviour. And again, when emotions come into it, because as people, we all have some really common similar traits, which is we tend to feel negative emotions or negative thoughts and feelings far higher than we do positive ones of the same magnitude. So to give you an example, Feel free to disagree with me if you like. But if you were to put $100 down on a bet of some sort and you lost $10 on that, I lost $10. You make $10, you go, that's all right. You don't feel it to the same scale. You don't get super elated that you made $10, but if you drop 10, well, you get a bit of a grumble. At least I do. So behaviour is really important. Behavioural bias, really important. There's an excellent quote, and it's excellent because I'm saying it's excellent, right? So I've got the microphone. An excellent quote by Jean-Marie Everard. Now, it's something like this. I would rather lose half my clients than lose half my clients' money. It's an approach that I see a lot of really great financial advisors take to heart when they're looking at doing their due diligence and considering what should go into a client portfolio. And I would put Mr. Goodwin in that bucket. Now, I'm not being paid to stand here today. Michael does not get paid by me, he doesn't get paid by Morningstar to use their services. He does his due diligence and has a look at the galaxy of different options out there to say, what is the most appropriate way to implement the strategies to get you where you want to be? It's what's the problem, what's the strategy to solve it, what's the right tool for the job? And so when you're considering that, it's an approach that I know he's taken for quite some time, and I commend him on it, because the biggest problem is then when risk comes along and markets get volatile, the biggest way to make sure that you come through the other side, because we always do, is to make sure that you can stay the course and you can have a journey that's going to carry you through in a way which you ultimately feel comfortable doing. Often it can be a matter of making sure we say, how can we fill the valleys when they come around so that you can enjoy the rise on the other side. So a couple of very broad sweeping statements. Thank you for bearing with me while I ramble on as a little bit of a filler. But please ask you again to welcome the horrible jargon language inducing Brett Finneran to the stage.
If there are periods where I suddenly stop talking, it's only because I'm trying to think about how to break it down. Now I know you can understand what I'm saying anyway, but I'll give it a go. You know, in the words of Einstein, I think in order to really know something well, you need to be able to say it simply. Okay? So you can test me during this presentation. Okay, so let's move on to the current environment. And if you just think about the year that we've just endured so far, and try not to think about October yet, or November for that matter, and just think from January right through to September, and you think about how good the equity markets were. For 9 months, you experienced good gains. You probably had some friends talking about the industry super funds and how well their investments were going throughout the year. And then suddenly, out of the blue, this happens. And what I'm showing you here is a chart, and it lists all of the major regions or equity markets. And you can see there on the left-hand side the percentage drawdown. I'm going to define drawdown. It's a peak to trough loss.
I still reckon that's a fine. You can't just throw it.
That's okay, I'm starting from a low base. At least you're not counting back from my last presentation. Looking at the markets, North America, Japan, UK, you name it, they all had a very rough ride in October. And it was all really centred around the US. And if somebody can just name the name, that'd be great. Trump, it was Trump. And his tariffs. That's the big concern. And it's still moving markets at the moment. It started off with Argentina and Turkey and raising tariffs, and there's still threats against China right now. What I find just fascinating though is that this all happened in 1 month. So you experienced 9 months, or you've seen equity markets perform so well for 9 months, and just like that, literally within 1 month, you had this. And depending on the time period that you actually look at, North America was actually down around 9%. That's a big fall for 1 month. It just goes to show how quickly gains can just evaporate. Which leads me back to you thinking about why you're investing in the first place. You know,
Can I jump in there again?
sure.
Just in regards to the Morningstar investments, when you look at a global fund, 54% of the wealth is the US. So if you go to most international funds, you'll find most fund managers will have about at least half in the United States or North America. If you look at Morningstar, their portfolio at the moment, they're only around 15% in the US. If you're fully invested in shares in an international fund. So this is where Greg was talking about before, they go overweight or underweight. They're seeing risk in the US at the moment, so they're definitely going way underweight, which most fund managers don't have the capability of doing that. So, well done.
I was listening very closely for the jargon. I'll get you back at some point.
Still waiting. Yeah, still waiting.
But you're absolutely right. So within the multi-asset portfolios, we actually use some of our own funds as the investments. So, as an investment manager, you would imagine that, we also run our own money in that we have our own investments that we use to build the portfolio. So we use direct shares and ETFs, exchange traded funds. I've just done it. I've just dived straight into it. It wasn't so bad, but I defined it, right? I defined it. This is going to be very difficult. And the third type of instrument that we use are managed funds, which are just pools. Think of it as a pool of different investments that we use. Okay, so it's what Michael talked about earlier, and it's an international fund, so it looks at global equities, lots of different regions around the world, and it looks quite different to what the index looks like. So an index would typically so that's a proxy or a representation of what the market looks like. This presentation is going to go for about 4 hours. Right? And you're going to be really bored with me by the end of it. So yes, as Michael said, we are underweight the US. Basically, we think it's really expensive. And the reason why we're not placing your money all in the US, like the index, is because it's expensive, and therefore there's a greater chance that there will be losses. Okay? And if I were to just give you one example, thinking back to the dot-com crash, if you had have bought the S&P 500 in 1999, placed all your money there, and just held it for 10 years, guess what your return would be? And if you guesstimate what this answer is correctly, I'll give you a bottle of wine.
Minus 45.
It's close. It's close. I'm going to give somebody else a chance to get closer to the actual number.
40.
No, I'm going to give it to him. It's 45. What was your name, sorry? Paul. Thank you, Paul. I'm going to give you this one.
He reached his notes.
It's a surprise.
I was actually guessing his age. I thought he has.
It was actually 50%, but I don't want to steal his thunder. It worked out to be a minus 4.5% return every year for 10 years. Okay, so
is this a long-term approach your company takes?
Absolutely.
Underweight US, you've been doing that for a long time, and you'll see yourselves continuing to do that?
It'll move through time as valuations change. So we're not.
Could you repeat the question?
Yes, sorry. So what was your name? Sorry, Robin. Robin asked if we're always, we've got a long-term approach, and if we're always, underweight the US. And so if I think about the US. Market prices change all the time. And as a result, valuations change also. And so we won't always be underweight the US. There will be a point in time when the US looks more attractive than the likes of Japan, emerging markets, and Europe over a 7 to 10 year period. But right now, the expected return for the US in aggregate, like think index, is actually minus 1% over a 10-year time frame. So remember, we're looking at those 4 pillars to identify what an asset class is worth. And so it's not a very rosy picture, okay? But what I can assure you is that when markets do fall, and they will, every 10 years, basically they fall. But as prices become better value, then we will start to buy more of the US. Now, you're not totally underexposed to the US. I mean, if you think about the International Share Fund, there's about 45% invested in the US. But we're not buying the S&P 500. We're not buying every company that's listed on the stock exchange. We're being very selective. Because literally there's about 125 US companies that we've bought into that make up a portion of that fund. Japan is actually one of the best value opportunities for us right now, and there's a really interesting dynamic happening with Japan, and it's all to do with corporate governance and how the boards are changing. And would you believe it? In terms of the number of women that are on boards now in corporate companies over in Japan, it's literally close to 50%. Right, that's changed dramatically. And if you think about Japan as in terms of value, it went through since 1991, which was the Great Depression. So property prices fell, equity prices fell. It went through a 20-year deflationary period. But things are certainly changing. And so with the changing dynamics with with corporate governance, there's more money going back to shareholders. Okay, and not just in the form of dividends, but buybacks. Now, this is happening all over the world, but Japan specifically. So Japan's been a great investment for us, and we've actually been there since 2011. Before I was actually working with Ibbotson or Morningstar Investments. I was overseas working with Merrill Lynch at the time, and I remember specifically, I guess that the time that Morningstar bought in, I didn't know it at the time, but it was the Fukushima disaster. And, we had already identified that Japan was a great investment. It looked great. Okay? But when that disaster occurred, which was largely the tsunami, which caused the catastrophe, it was after that we bought. We bought Japan. Why? Because prices were so depressed at that point in time. Nobody's thinking about buying at that stage. Everyone thinks that the world is about to implode. And it starts with Japan. And the world will follow. But it didn't happen. It was a natural disaster, initially. And, if you think about the reported number of deaths related to nuclear, I think there's only been one reported to date. Can you believe that? So, looking at the UK, there's a lot of uncertainty in the UK at the moment. Obviously, it's all to do with Brexit, and we don't know what is going to happen. We have, ideas as to what the different scenarios are and maybe how they will play out. But what you need to do is you need to have a probability-weighted approach. So, being good at investing doesn't mean that you have to know all the answers. It just means that you need to be aware of the type of landscape that we're in and be prepared for it. So one of the first slides that I showed you was, you can't predict, but you can prepare. Emerging markets, they've been through a lot of stress lately, both the currencies and also the equity markets. That's one of our...
What countries would be in emerging markets?
China would be one. Our favourite is South Korea. We also had Taiwan in the portfolio. But that did so well that we took our profits and sold out. Okay? So as you can see, as valuations change through time, we buy and we sell. We don't tend to trade very often either. Remember, we don't trade on a short-term basis. We look at the long-term value of an asset class. We trade on that. So if you think about the number of trade updates that we have throughout the year, on average over the past 5 years, we've had 3 or 4. Nothing's really changed there. It's not fixed, it's not scheduled, it's when valuations change. And that's when we trade. We trade for a very good reason in the first place. Think back to 2016. So at the beginning of 2016, we had the worst start to the financial markets in history. You may not remember it now, it's just a blip in the ocean, but back then, things looked really concerning. We traded during that time. We bought European equities. Two other things occurred that year, Brexit and Trump. Now, interestingly, we didn't buy more US at that time. We didn't think we predict that Trump is going to become president and therefore it's going to be great for equities. What we saw was that equity prices were already too high. Now, something to ponder here. Are you wrong because the market moved not in your favour? If we decided not to buy or load up on US equities, does that mean you're wrong? What do you think? Does it mean that you got it wrong? You can make mistakes, that's true. I wasn't going there with mistakes, but I think everybody makes mistakes.
But there's still value in it.
Yes, there's value in it if you're selective about what you buy. That's right. And I think if you believe that your data and your reasoning are right, if there's a good enough reason not to buy something because it poses too much risk, then you don't do it. Remember, we're investing your money. It's not our money, it's your money. So clients' interests always come first. And Australia, good old Australia. We're very underweight, Australia, relative to our peers. And I'll be very simplistic about it, it's just not as good value compared to the likes of some of the other markets I've mentioned earlier, like emerging markets. This may sound a little bit silly to you, but the expected returns, the valuation implied returns for Australia are sitting at about 1% over a 10-year time frame. Now, you've still got weight attributed to Australian equities in your portfolios, but you'll find that it's highly concentrated. Okay? And the majority of your money is invested in those other markets where the valuation implied returns are much higher. Okay? Let's see if I can get this pointer right. Okay, so in light of everything that you've seen over the past, so this data here, this line chart takes you back to the end of October.
That graph qualifies as jargon in its own right.
I don't think so. I don't agree with you. It's just a squiggly line, Matt. I don't know what you're talking about.
I think that's great.
Isn't it? It is terrific. It's
Earthquakes.
abstract.
Earthquakes.
Yeah. Fault lines. Yeah. So I mentioned earlier valuation implied returns. All that means is that we're looking at the valuation of asset classes and working out what we can get out of, like in terms of return, how much return we can get over a 7 to 10 year time frame, based on valuations, based on inflation, and based on earnings per share growth. Okay, so we can work out those things. We've been doing it for a very long time. But if you look at the line graph here, the squiggly lines, they have fallen somewhat, especially over the past year or so. They have become a little bit more attractive here. So basically, when the equity markets are looking a little bit more attractive, you'll see the line point up. Okay, so the expected returns are higher. So let's look at a few of these. Okay, you've got Australia there, here at about 2% after inflation. You've got the US, which is just above zero. My apologies. But you'll find that Europe, Japan and the UK are all screening much higher. Okay? It's a great time to buy. There's a lot of uncertainty. You know, when there's blood on the streets, that's when you buy, essentially. Okay? But you need to have good data and good reasoning to back it up. Okay. So, valuation implied returns. I'm going to break this down simply again. I've just taken a subset of asset classes that we cover. This is not all of them, but these are some of the main ones. And on the far left-hand side, you can see what the expected real returns are. Okay? So all that means is that we look at what we can get from the asset class after inflation over a 10-year time frame. And I've put them in order so you can see the most attractive on the left-hand side and the ones that aren't looking so good on the far right. The red column represents the current valuation implied returns, and the yellow column represents the valuation implied returns 1 year ago. So things have changed. You know, if you factor in the falls in the equity markets that you've seen recently in October, like Australian equities or global equities, you can see now that because markets have fallen, the expected returns are now higher. But does that mean, or does that warrant a time for you to deploy all of your cash into the market? No. It's not good enough in some cases. Remember, investment cycles tend to last around 7 to 10 years on average. Okay? And we've experienced 10 years of phenomenal growth. And that's been, I guess we're going to credit a lot of that to low interest rates. Look at how property prices and equity prices have moved as interest rates have been pulled down. They're basically moving inversely to each other. So now we're at the other stage of the cycle whereby rates are moving higher, particularly in the US. And as a result, if you think about the time value of money, think about how we discount future cash flows, it means that equity prices will come under pressure over time as rates rise. Now we've got the same chart here for defensive assets. Now, if you have a conservative separately managed account or a balanced separately managed account, then you will tend to have more cash and bonds, compared to a growth portfolio, which would typically have around 70% growth assets. But the good thing is, though, you still have exposure to those great markets that I mentioned earlier, i.e. Japan, emerging markets in Europe. Bonds are in a very interesting place at the moment. They're supposed to be the defensive part of a portfolio, right? But the interesting thing is, with rates so low, it means that bond prices move inversely to interest rates. So when interest rates move down, bond prices move up. Okay, that's the relationship. And when holding bonds, for maximum safety, you want to have short, this is a tough one, I'm just going to say it anyway, duration. Okay, duration is just the sensitivity of a bond to a 1% movement in interest rates. Okay, but the shorter the duration of the bond, so 1 year, 3 years, think of a term deposit for a 1 year. So that duration would be 1 year. Okay, if you had a three year bond, then it's a 3 year duration. So think in terms of that. So when you look at our portfolios, we tend to have very short duration within our portfolios. If you have much longer duration, then when rates rise, bond prices can fall quite dramatically. And you've probably not seen this for quite some time. Okay?
Can I jump in there for a
Sure.
moment? If I can take everyone back to when I'm coming to my boardroom and had their meetings, I've explained bonds are like an upmarket term deposit. And what Fred's been trying to explain is if you have a longer term deposit in this area, in the bond area, it actually increases more risk. So what Morningstar have been doing is reducing the length of their term deposit or bond length to actually make it safer. I think that's another way to do it.
It's good. Just racking up those charitable donations. It's a good thing I brought the corporate card. But I would invest my own money in that. The other thing you'll notice with our portfolios is that we have a lot of cash. And you're probably thinking, what are we paying you for? Then why have you got so much cash? Shouldn't you use it? Shouldn't you deploy it in the market? And you know what? The time will come. Okay? But we refuse to buy expensive stuff. Okay? It's that simple. So there is a lot of cash. There's a reason why we use cash as a defensive asset. It means that it's highly liquid. It means that when cheap assets become available, we can buy them. We don't have to sell something else to buy the assets. We've got the cash ready to go. So it's a very strategic decision to hold cash. So this is from one of our communication materials that we provide to advisors and clients. What we tend to do with our valuation applied returns and our analysis of asset classes, we break it up into 5 components. And so on the far left-hand side, you have asset classes with very low conviction, which basically means that the expected returns are very low relative to peers. You have medium conviction, and then you also have high conviction. And the higher conviction asset classes are those that are actually screening the highest. They're some of the best investments. And it's quite funny to see cash up there. Okay, it's hugely important to us right now. Cash is king right now. It's not always cash is king. Okay, you don't want to hold cash over the very long term because it affects the purchasing power of your money. Okay, but when you're using it to buy undervalued assets during stressful times, that's when it's key. And that's why we've got a lot of cash at the moment. The interesting thing is too, if you look at the returns of our portfolios, all right, over a, say, 3-5 year period, well, let's keep it simple. Let's look at a 1 year time frame. We've got a lot of cash, right? So be it. But if you compare us to the likes of Vanguard, right? Now, Vanguard is an index fund. It just tracks an index. That's how it invests clients' money. Now, part of being invested with Vanguard, it's a more passive style. You don't actively buy cheap assets. You tend to just get exposure to the entire market. Now, you would have been doing pretty well up until the end of September. Okay, your portfolio may not have looked so good relative to Vanguard. But how funny, how quickly things can change in just 1 or 2 months. And it reminds you of just how important it is.
Is Vanguard tracking the Australian market?
Yeah. So do they track the Australian market? They track every market.
Oh, so
Yeah. Now, just thinking about what index funds are, I'm not going to shoot them down, but look, it's a very cheap way to invest. You get what you pay for. Okay? You will buy an index which is made up of lots of different companies that represent the Australian market, for example. And the way that it's constructed is that you have most of your money in the highest weighted companies. So if there's a lot of shares on issue and the share price is really high, then that's where most of your money is going to be invested. It has no relevance or no regard to how much the underlying company is worth. It could be a terrible company, right? It could be like a Bitcoin of a company, have a very high price, lots of shares on issue, therefore the highest market cap, and it's right up there, one of the top weights within the index. It just doesn't make sense as a value investor to invest that way. Just conscious that I've got a bottle of wine there that I need to give away for any questions or yes. The bottle of wine, I'll walk it over to you.
So on that slide you just
Oh, yes.
from,
Yes.
UK is a higher conviction, but then a few slides back with the red bar chart actually was performing similarly to US and Australia, so I'm intrigued to know. So go back another slide. Again. Sorry, keep going. That one there.
Yep.
So Japan, emerging markets, yeah, high conviction, but you had UK high conviction as well. So
this is
dissimilarity between the two.
So this is a
You repeat the question?
sure. So your question, your name, sorry? Adam? Thank you, Adam. You just mentioned there's a bit of an anomaly there between the UK, the price of how it's returned, and our conviction in the particular asset class. What this slide tells you is that it's the peak to trough loss.
Okay.
So this is showing you at the highest high, right, how it performed during the month of October. And during the month of October, it actually fell just under 5%.
Sure.
Yep, relative to the likes of Japan, okay, and North America, -7. Now, just because we value the UK or the US or Japan, Japan and UK and Europe better than North America, it doesn't necessarily mean that it's not going to fall the least. We can't control what the market does, but what we can control is what we pay for an asset and how much it's worth. Okay, so North America actually fell closer to 9% during that time.
Sure.
Okay, so in terms of the anomaly, I may not have answered the question completely there, but so the anomaly is.
So if you look at the slide we were on before,
Yep.
Japan was a high conviction,
Yep.
and so was the UK, but this chart here shows UK as being lower alongside the likes of Australia.
Right, so what this, thank you. So yeah, this chart will show you that the UK fell the least in October. Japan fell quite a lot. Okay, the way that you've got exposure within your portfolios through the iShares Japan ETF, that's unhedged. So we're also very bullish on the yen. So the net return is actually around 6%. So minus 6% for Japan. Now, all this is showing you is how they fell during the month of October. But in terms of the valuation implied returns, which I'll just go back there now, was it this chart that you were?
It was the one you were literally the last one you were on.
Oh, this one here.
Because the emerging markets of Japan.
Yeah. So because they're high conviction, so it makes sense that the UK fell the least, right?
Okay.
So, if you've got an asset class that you believe is good value, and it falls the least, well, that's a good result. But I think the anomaly that you also mentioned here is Japan's also high conviction, but that fell. That fell 9. And so, going back to what I said, so you can't really control what the market does. The market in the short term is more of a voting machine. Okay, where people like you and I register your votes, buying, selling. Okay, but over the very long term, it's more of a weigh-in machine, where price will revert to fair value. That's usually how it works. So Japan, the reason why it would have fallen further is because of Trump and tariffs. So basically, all of those Asian economies are going to be affected by the trade war. But if you think about your portfolio, having that exposure to Japan and the particular ETF that we're using, it's a two-pronged approach. So we're bullish the yen, okay, so it's an unhedged investment. Basically, if the equity market falls, so be it. We still think that it's really good value, represents good value. But at the same time, the yen is seen as more of a safe haven asset. Okay, so it buffets some of the fall.
Great.
Sorry about that.
No, thank you.
Because I was so complicated, I'm going to give you that bottle of wine, and we can maybe share a glass later.
Yeah, that's fair enough.
It's a good trade, I think.
So how many fines are we up to at the moment?
I think I've given away about 5. Right? Okay, so just a few things to take away. I know that I've been very heavy on numbers and valuation implied returns and drawdowns and things like that. I was really hoping that I'd say more jargon words to donate more to charity. I think I might just let it rip. Yeah, right. Well, I'm not going to read this out word for word. But just if you could just take a few things away, valuation implied returns are really just expected returns that we believe that we can achieve over a 10-year time frame. The way that we can actually construct those is by using those 4 pillars. Okay, what's the absolute valuation of an asset? How much is it worth relative to other asset classes? What's the fundamental risk? And using our contrarian methods, we can understand how others are invested, whether or not they're overcrowded in a particular trade. And although expected returns are quite low at this point in time, it doesn't mean that it will always be that way. But just if you can just remember that, you know, we've been through 10 years worth of growth. It's been 10 years post the GFC. Okay? Trees don't grow to the sky. It's as simple as that. Okay? You know, we hope that things keep going and that we can get double-digit returns for 20 years, but it's just not sustainable. At some point, asset prices do pull back to fair value. And we think that the best opportunities at the moment are the UK, Japan and emerging markets. And last but not least, cash. Okay, it's, you know, not something that you want to hold over the very long term. Okay, you want to preserve your purchasing power. You can do that through your portfolio, but you also want to use cash strategically to buy really good quality assets when they become available.
When you say long term cash, what is that still 7 to 10 years cycle, or is it slightly shorter term? Because I just see you only want to sit on cash for so long. Even if you buy something at a slightly higher price, albeit you don't want to pay too much, you're probably going to get a greater return than what you are by leaving it back. So, how long do you mean by sitting on cash for longer term?
Yeah, that's a good question. So, how long do we stay in cash?
Yeah.
You know, we could buy something that's offering better value. So, cash is a very strategic weapon for us. We could go out and buy something a little bit above fair value. I guess hoping that somebody else will buy it from us at a later time. But we'd rather not take the risk. You see, it's more of it's short-termism. You know, instead of thinking, okay, let's try and extract a little bit more return for the next 12 months or so, we'd rather wait for a really compelling opportunity to come about. And they happen all the time, you know.
I just thought it was interesting, given how low that you said, sit on cash longer term, given how low interest rates are in the bank, whether it might be a risk preference. Then you're saying I'll pay slightly above fair value and sit on it longer term there, because I'll get a greater return than I'll get by living in the bank.
And that makes a lot of sense. It does. So we won't hold it longer term. Okay, we'll hold it throughout the investment cycle. It'll build up. If I can give you one other example, so we've got some real return funds. Okay, they've been running since the early 2000s, but the valuation-driven strategy that we have started in 2009. Now that one of the funds, it's called a growth real return fund. It had about 3.5% cash in 2009. Now, gradually, over the past 9 or 10 years, that weight of cash has increased to 25%. Okay, so it's been gradually building up. Interestingly, that particular fund is top quartile over 5, 7, and 9 years. So, in no way, shape or form has holding cash been something that holds us back. Okay, we've used it strategically through time. Okay, so I'll show you the last slide, which relates to performance. And so a lot of you would either have exposure to the moderate or the balanced separately managed account. And we've got data here on this particular slide just going back to late in 2013. This is how the portfolio has performed through time. Has there been anything that relates to your portfolios that you've been really interested in asking? Like something that's been top of your mind that you'd really like to dig a little bit deeper down into to understand the mechanics of how it works or why we did a certain thing over the past 12 months.
We're keeping a lot in cash, understandably, because things are very expensive, and when they're expensive, they're likely to fall rather than go any further. That's pretty correct, yeah. If you use a little bit of that in cash, it's like a bit of a gamble, just for a short-term pickup here and there if you saw it. Would you do something like that?
Short answer is no.
No.
Okay.
It's not wise investment, is it?
That's right.
Yeah.
We can, so, you know, if there's a great little opportunity, short-term opportunity, can we use the cash to buy to get a greater return than cash?
Yeah.
And look, technically, yes, we could have done it.
It's a gamble.
And that's why we're not going to do it.
Yeah, you won't do it.
It's speculative.
Yes.
Although, we will buy something if it's below fair value.
It's not investing, no, it's gambling.
So, you know, it's, yes, we could use the cash to do things like that, but, you know, we're really always looking at the reward for risk. And I guess if I use the US as an example, you know, we could deploy more money into the US right now, extract some return, you know, hoping...
It could go up.
It could go up, that's right. It could go up for another 2 years. We could do that, but it could go down too.
A lot.
At these valuation, I'll say one thing about the US. At these valuation levels, you'll probably laugh at this, but the conditional drawdown, so how far the equity price can actually, the market can fall at these valuation levels is 70%. At these valuation levels. So we can invest client money now and look good compared to our peers. You know, look how good we've done. You know, we've beat, you know, the index and extracted another 2% out of the market, maybe 3%. Or we can be sensible or more prudent with your money and hold back and wait for a better opportunity to arise. So I can assure you, you know, if the market does fall, we go through a recession, and, you know, if you read the AFR or the Financial Times, I mean, there's lots of different investment banks quoting that, you know, there could be a recession in 2019 or 2020. They're all trying to predict when it's going to happen. I can guarantee you that they won't all get it right. Okay, everyone's still dancing because the music's still playing. But I can assure you that you will have cash to buy good quality assets when that happens. And that's the key. That's what is going to give you more stability in returns over the very long term. So on that, I'll wrap it up. Please.
Could you ask how many people would be comfortable now keeping most of their assets in cash for this event that could happen, may happen, will happen?
So how many people would feel comfortable leaving money in cash right now, waiting for that opportunity? Not very comfortable, actually. I don't think many people would feel very comfortable leaving their money in cash.
It's not a comfortable position, but
no.
Would you rather the other position of not having in cash and having fully invested somewhere that would have a big fall?
See, the interesting thing is that with holding cash and having the option to buy something, you can always, you know, people always think about the return. You know, Matt mentioned earlier, he's standing over me here, I feel a little bit. He's like a security guard. Look, we could hold the cash, okay? We could buy something, okay? But the thing is, we've got to always look at the reward for risk. And if it's not worth the risk, then we're certainly not going to do it with your money.
Can I actually answer to that one a little bit?
Absolutely.
So I'm going to jump in. We'll throw out. And we've got more courses to come, so please take advantage of Brent while he's here and ask more questions, please. One of the challenges that a lot of professional managers have that are used out in the broader marketplace to run and look after money is they don't, whenever a fund is set up, they have a constitution, a set of rules that they have to abide by. And a lot of these funds are set up so that they don't give the manager flexibility to actually put money aside for a rainy day sorry, no pun intended, but to put it aside for this opportunity. So they have to be fully invested. They don't get a choice, which means even if they don't really see an opportunity to buy a well-priced, good quality asset, their constitution may say they must have all their money invested here, 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 and here. So they just have to go and do it. Morningstar does.
That's right.
So I just thought that was a point.
Yeah, no,
worth
that's
raising.
right, yeah.
I'm sorry, there was a question at the back of the room.
I was just wanting to say, I'm personally very happy that you have cash resources, because with breakfast coming on, it will affect both British investments or United Kingdom investments, plus European investments, and I see this as a very wise and balanced way of looking at it. Thank you.
Thank you.
Yeah, I do too. Technological question, if you like. The contrarian indicators that we're talking about, are they like utilising the flip side of risk, which is opportunity? In other words, looking at risks and then recognising opportunities that come from that?
Yeah, absolutely. So, contrarianism.
Can you repeat the question for the room here?
Absolutely. So the question was with regards to contrarianism and one of the factors that we use to understand the market. Can it help us evaluate opportunities? So one of the tools that we do use is the Bank of America Merrill Lynch Fund Manager Survey. And so literally it's a survey completed by all fund managers globally, and it helps us understand where they're invested. Okay? It tells us what they're bullish on, what they're bearish on, and where they're currently invested. So that actually helps us understand more about how they're investing.
Yep.
But we can match it up with our valuation implied returns. Okay, so if we know that something's a good buy, right, and they're not invested in it, or maybe they've got a consensus estimate of earnings over the next, say, 7 to 10 years to buy into that particular asset class, then we know that it's a screaming buy, essentially. So we match it up all the time. But it's a really good way to gauge what others are doing.
Yeah.
And you need to understand what others are doing in the marketplace.
It's a forward look.
Yes. Yes, it is.
Thank you.
Any other questions?
I've loved it.
Okay. Thank you. Thanks for your time.
Thank you. Thank you.
If you could please put your hands again together for Brent. That was great. Thanks. Whenever I'm listening to a presentation, I always, different things jump out at me at different times and for different reasons. There's two probably that came out of Brent's presentation today. One is harking back when he's just looking at the scale of Morningstar in terms of what they can achieve. Can I ask everyone to consider for a moment what brand of phone that they have in their pocket or their purse today? And I'll suggest it's either got a piece of fruit on it or it's made by a company from Korea. Is that fair? Has anyone got a Nokia? Is anyone brave enough to admit they've got a Nokia?
Or a Windows phone.
Yeah, or Windows. Wow.
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 How good would that be?
That's not fair view. So the reason I call out the phone example, I think, is just one to give you a little bit of an idea that the world that we live in, either through our working life, through retirement, is a global one. And so it very much makes sense to have a manager who is looking at different opportunities globally and not taking too much of a domestic view on what we do. So that becomes really, really important. It's also important, we're talking about, and this can get to be a bit of an interesting concept, we're talking about that idea of buying the index, or buying everything in the market. So it doesn't matter what the quality of the business is, you buy it. Back in the 80s, there was a company with a market cap, so it's his market, that's one thing I just got to find. There was a company whose value was $30 billion. And it was very, very popular. Everyone knew it was an absolute household name. The company was called Kodak. So if you have $1.8 billion, it's just about to come out of bankruptcy and looking at relisting They sell a lot of digital printing now. It's into printers, devices, things like that. 3D printing, digital printing is what they're focusing on. Legend has it, there was a chap at Kodak who actually came up with the idea of a digital camera. And the executives at Kodak said, no, we're not going to do it, it's going to cut into the film business, it'll never take off.
No future.
Whoops. $30 billion, to give you an idea, roughly about 20 years ago, is equivalent to the market cap or value, equivalent to the value of BHP today. That's the size of the business. It was big bucks. If you bought the index and you weren't thinking about what the future was, you would have owned Kodak. You probably could have, if you were taking the time to think about where you were placing your money, thought, you know what? Maybe not the best idea right now. So it's not to say indexes are bad, they just are the right tool for the right job, but I believe it's making sure that you've got an idea behind how you're investing. It's about not taking on risk unnecessarily, and it's taking on the amount of risk you need to get the return that you want, not taking on more risk to get the same return that you'd otherwise get.
That's it, the time's up.
Here's my time, is up. Right, please ask you to welcome Michael Goodwin to the microphone.
Well, I just want to obviously, hope you enjoyed the presentation. I think the information was invaluable. It's also nice to hear it actually from the company where I get my research from. So we actually have 8 different research companies. Morningstar is the main one. And the strength of professional investment services is we're not tied to a platform or an investment we have to use. So the strength we really have, I can actually use whatever investment I want to that suits your goals and objectives and to actually get from point A to point B. Where if I'm employed by certain companies, I have to sell their product. So that's why I've been with professional investment services now since 2003. So I think that's been a good marriage that I've been in. Brent, where are you, mate? Over there, thank you very much. I think that was great. I think the vines went too bad. But some people enjoy those, which is good. But some of you don't know that actually last week I was in the US and I went over there for 2 reasons. One, to have a break. But 2, I wanted to see for myself what's happening over there. Because I have been seeing Morningstar being well underweight. And over the last decade, the US has actually done really, really well. But the risk, as you heard, they could go -70. I haven't heard that before, I've heard -50, but their risk is even getting more dangerous. But I can tell you from my 5-6 days, or actually 7 days over in the US, I can't believe how overconfident they are at the moment. And they are spending money like it's not going to run out. I stayed in the Airbnb over there, and I've got to say, when I walked into this block of apartments, it's going to sound a bit wrong, it looked like a brothel. But the room I stayed in was a 2-3 bedroom apartment, and I looked at it, and on the Sunshine Coast here, it'd be worth probably around 310,000. This building this one apartment worth 2.2 million. Wow. They are overpriced in so many different areas, and they're living like kings at the moment. Now, I'm not going to say they're going to fall 70%, but what Morningstar are doing are making sure that they're protecting your capital. And they see risk there, and they're thinking, okay, well, maybe going to Japan or going to Europe, okay, well, we can still get a decent return with less risk. So that's what Morningstar are doing. I really like that. And yes, they probably have been more conservative too early. But I've said to all of you, I'll never apologise for going safe with your money, because it's pretty hard to get it back. But we'll see, I believe over the next few years that will change quite considerably. From notes that I took down from last year, we always strive to actually improve what we're actually doing. So I asked all of you last year something that we can do and how we can improve the business. So one of the major things that came through was to try and improve our education to our clients. So I'd like to go through some of the things that we've actually implemented in the last 12 months. So we set up in February this year the Ethica Knowledge Centre. You all received an email, and if you've come in for a review, which I have, I've actually taken you through that. And basically it's a company I employed down in Sydney to put all the information about what's happening in the financial planning area on investments. So you can actually do like a Google search and learn what's actually happening. And I'm pleased to say that a lot of people are using it. If you're not and you want some help, please call Jen and Di. No, just give us a yell and we'll actually step you through it. We've also made sure the website is continually updated, right, for information for people that are looking for a financial planner. Now I do know most of my clients actually don't go to a website, which is fine, but actually on there we do have videos. So if you wanted to see the presentation from today again, you went to ethica.net.au and go under videos, you will see this in the next couple of weeks. I hope, Ashley. All right, which will be good. Don't put this one down. We're always aiming for exceptional service. We don't want good service, we want exceptional service. So if we're not actually doing it, tell us. Give us some ideas of how we can always improve. All right? Matt actually said that I'm not paying him today, that's correct. But I get paid by you guys. So give feedback on how we're going, which you are, because we're always striving to improve. We don't want to stand still. We always want to improve. So we take good feedback and negative feedback. Because from the negative feedback, if we have had some, we look at it and try and improve it on an ongoing basis. I read in the paper yesterday, the main paper I use is called news.com.au. That's probably because I don't like buying the paper and I like to look at it on the net. And it's always kept up to date with what's actually happening. And yesterday they were talking about Sydney prices and how they've fallen since July 1 last year, up 0.1% off the biggest crash ever in history in Australia, and the last one was 89 to 91. So 0.1%, and they're forecasting, or CoreLogic, who does the reporting, we're expecting another 10 to 15% fall. And I think we have two brokers in the room here that will actually say it's getting very, very difficult to lend money. They do a lot of work but don't get paid for it because the banks are knocking back loans because they're getting harder and harder to borrow. Something else that I'm very, very proud of my office that Di, Jen, Dave and myself have actually done is I said we always try and improve the business. So I get asked, what do we do well? Well, I haven't worked for anybody else for well over 25 years. So I don't know what we do well. Alright? So I actually put it out to consultants to see, okay, how do we benchmark against the big boys in Melbourne and Sydney and how can we improve? So we put ourselves into a competition this year and see how do we compare against the other guys. And we're actually compared to around about 2,200 planners. We made it to the final three. But even better than that, the announcement for the person that won was done out in Vietnam at our conference. So Jen and Di came over, and when it came up on the screen, I said to Jen and Di, I don't want to come second, because no one remembers second. I either want to come first or third. And then the names came up and our name wasn't there. There was two left. So I thought. We actually won the advice firm of the year. So we're a very fine. And that's actually done from the team, but it's also done for Matt, it's done for Morningstar, it's from all the people that work with us. Because if everyone in the room who works with me would probably say that I'm can be difficult times and I'm pretty pedantic. I do like things done the right way. Now a lot of you in the room too are using VMAPs. And VMAPs also put themselves out there to see whether they are performing against other platforms. So a platform is not Morningstar, VMAPs is the platform. It's like an accounting software, then you put your investments on top. Now they were already number one in Australia. So they went into the global competition. And about 6 weeks ago, they came first in the world in London. Wow. So you guys are now on the best platform that's been voted independently in the world. So you've got a good fund manager, a good office and a good platform, so I'm hoping we get some very good returns in the next few years for you as well. And start spending some of that cash.
So who caused all that, Michael?
I have no idea. We also every 2 years do an independent survey through a company called CAT-SCAN, and where you sometimes may get an email from SurveyMonkey, and if you use that, we can see where replies come from. Now, if I ask you, are we doing well or doing bad, I'd like you to tell me the truth, but I know sometimes you might be embarrassed to tell me if I'm doing something wrong. So we use independent consultants to actually write to our clients. I don't get to choose the clients, and I don't see the answers or where they come from. I do see the answers, but I don't know where they come from. We've now done it 3 times. The first time was 6 to 7 years ago. And what they do is they grade it into the top 25%, second 25%, the third and the bottom. I thought you guys loved me, and I came in the bottom about 7 years ago. And there were some real negative things in there that I had to work on. So as an office, we took that on board.
Sorry.
When I went out to CAT-SCAN, and I was actually hurt by it, but I took it on board and said, how do we improve? They said, well, hold on a minute, you put yourself out there and had an independent audit done. Most companies don't do that, so already you're ahead of the pack. But of course, I want to improve all the time. So we went through all those issues and started working on them. Then did another CAT-SCAN report 2 years ago, and we finished in the top 25%. So I went from 4th to the first quarter, which I was really happy about. We then did it early this year, again we're in the top quarter, but out of the 10 key areas, 9 improved, 1 didn't. And that one that didn't improve was the way we explain our review process to you. So we're now working on how to improve that to make sure that you understand what we're doing, not just telling you what to do. So please ask questions when we're in the review process so that you really understand what we're trying to do with your money. We're actually doing investment updates on a regular basis. So you all would have got an email about 3 weeks ago about all the buys and selling we've been doing inside your portfolio. Just to let you know, again, it's your money. You probably should know what's happening with it. So can you please thank Clint for that one? Because Morningstar actually helped me put that together and to try and make that as clear as possible for you. We're also starting, or have started, what we call How Are Things Going? So we're going to give you phone calls once or twice a year, and just to see how you are. Not to talk about the market, just to talk about how you are. Because financial planning is not just about dollars and cents. It's about lifestyle. So I don't want you to go to bed at night worrying about your investments. If you are, it means you've got too much in the risky areas, and I know in my room here, we don't have that at the moment. So our performances aren't exciting, but they're safe. They will become exciting, and I'm a little bit different from most planners. When the market does crash, you'll suddenly get very excited. So that's when we do our reviews, we'll start buying again and start getting some really good returns. When everybody else is really nervous, we can actually take advantage of it. Sunny Kids. Does anyone know who Sunny Kids is? It's a local charity, right? Yep. And it's basically helping children that are in our school network or having problems at home with their parents. And there's basically a charity that actually helps that. So we basically helped 755 kids this year. And 1,600 hours in Sunny Kids. I can't say that's all of Ethica's money, but there's a lot of businesses on the Sunshine Coast that support that, and we're certainly one of them. We do that on an ongoing basis. So the fines will go to helping the kids on the Sunshine Coast. I now have a bit of fun and actually thanking a few people. So I'd like Jen and Di to stand up. I'd actually like them to come to the front of the room. And Dave, you go up front too. Jen, I was going to say you're going to get though. She said, no, I'm not. Have a few words? I just wanted to say thank you. A huge thank you to these 3 people. Because without these 3, I cannot run the business the way I do and perform the way I do. So we do work very much as a team effort, and the award we won was the advice we gave. It wasn't for the size or the returns, it's for the way we give advice on an ongoing basis. And that looks at our corporate, how we do our compliance, and we've had some fun there because we've argued with our compliance department in the last 12 months to say they're wrong, and they don't quite like it like that. So we've had some challenges, Jen says sometimes I'm too open to them, but I prefer to be very open and get it right. So I just want to say thank you very much for that. A little gift for you.
Yes, sure.
Jen, I think you'll like that.
That looks like a bottle.
Di, I think you'll like that one. And David, I think you'll like this one. So thank you very much, Jen.
Who's next?
Matt. Oh, my dear fella. And Brent. You can come up as well. As you may have heard, this is our 4th year of putting this together towards Christmas time. And a lot of work does go into this, and obviously it's not just my team, it's these guys. They obviously speak regularly, but they are very, very good at what they do. So an example, Morningstar basically in my office every month. They tell me they don't do that to any other financial planner in Australia. And that's because I pretty much expect it, because I want to know what's happening with your money. I want to make sure that when they start buying, if the market starts going overweight, we can do the same with your money. At the moment, I'm being very conservative, so if I get a 2% return or 1.5% return, which is not overly exciting, that's a lot better than -7 in 1 month, which could be a -20 or a -30 over 12 months. But when it does do that, that's when you'll see a massive grin on my face, because these guys will be buying with your cash, right? And we'll start getting some good returns. Matt obviously also comes up every month and works in my office, or not in my office, but actually looks and helps me, making sure that I do the right thing. As I said, I don't know how I compare to other people. These guys have worked with lots of other planners and other businesses, so I get feedback from them on what's working well outside, and I don't believe you have to know everything or design it. You can learn from other people, which I do, and then I use that information to actually help our business. So a thank you is not just for today, it's actually for the last 4 years. Brent, you're lucky that you're here today. So we had Clint last year and Regan Van Der for the 2 years before. And if anyone wants to know what Regan's, actually Regan's now living in New Zealand in another company. You've been saying down the back, hopefully he sounds terrible if he fails when he comes back. Alright, but thank you very much for the work, and a gift for you guys. And the most important people in the room are the ones sitting down enjoying the wines and the food. Without you, this can't happen. So I want to say a very big thank you to all of you for your trust, your patience, and it has been a lot of patience in the last couple of years, but you're starting to see now that's paying off. And I think that will continue over the next 2 or 3 years and even further in the future. I haven't got big presents like this for you guys, I apologise. I hope I can deliver that in your portfolios next year. But on the way out, we do have some gifts at the back for you. So you have a choice of basically a very good bottle of red, or you've got some candles. Now the candles, the people in the room saw these 2 years ago, because we're actually supporting a young lady to put herself through university, who's just finished and she went through with honours.
Oh, wow.
So I think that's been fantastic as well. So you have the choice of please take on when you leave. And I think we've got another, how many courses to go? How many courses do we have? 2 to go.
We're not counting.
So we have a lot more fun and a lot more wine. So I just want to say thank you very much. And I now pass it back to Nate.
I think it was a little bit easier. I wasn't really expecting that, so thanks, Michael. Well, I'll try and keep my closing remarks reasonably succinct. And what I'd like to, the 2 things I'd like to tell you something and I'd like to ask you something. I work with quite a few different financial planning firms and provide a lot of consulting and coaching to them. It really gets me out of bed every day. I was a partner in my firm, in a firm myself for quite a number of years. We were very successful. The firm's still going. And one of the reasons I do what I do today is through working with a lot of great people like Michael, I vicariously, or one step removed, get to hopefully use some of what we learn, how we approach things, and reach a whole lot more people. I just don't get to meet them as closely as I do get to meet you. One of the challenges for me, though, stepping away from the tools directly, is I often do a lot of work for friends and family, and when my best friend came to me and said, "Hey, I need you to do something for me," I had to say to her, "Look, mate, I can't. I kind of work at a different level now. You really need someone who's really got their finger on the pulse. Can I introduce you to someone?" The person I wanted to introduce them to wasn't available, so I said, "Look, Michael is available." That was a joke. No, out of all the ones I could have chosen, Michael was my first call. So this is a little bit of a ask not what your country can do for you, but what you can do for your country moment. Look, businesses like Michael's often rely on word of mouth in order to grow successful and be prosperous. Could I charge you all just with one challenge at the end of the day, which is please don't keep Michael a secret. If you know people in your life that can benefit from a great advisor, please ask them if Michael can give them a call and just introduce himself and have a chat. I know he and his team would appreciate it knowing. That's the one thing I've asked of you today. I'll wrap it up there and say it's been wonderful to see so many familiar faces again this year. I do have a face for radio and the voice of a novelist, so thank you for putting up with me and my clearly terrible jokes. I hope you enjoy the rest of the meals today, and more than happy to have a chat to you myself through the afternoon. Thanks, everyone.